Yo, what is good? We're back with another video. Today we're going to be going over the ICT unicorn model, which is a breaker and fair value gap combined. If you're not in the free Discord, go join it. It is linked down below, but let me show you exactly what this would look like. So we have a high here, we have a low, and then we have a higher high, right? So this high right here is higher than this high. And then we come down and we break below this low right here with an imbalance here, or it doesn't really matter where it's at, wherever the breaker is that overlaps with the fair value gap. Price will usually trade back up into it and then have an immediate reaction, or not always, but you would prefer an immediate reaction off of this unicorn setup. So let's hop into the charts and show some examples. So on Friday before news, we actually had a great example of this unicorn model. So what you need for this unicorn model is an obvious draw on liquidity. So if you have the draw on liquidity wrong, this is not going to work. You have to understand where price wants to gravitate to. So on Friday, my eyes were on this 66 level. So right there is what I was watching for. And if we see right here, it is not as pretty because NFP did have this wick up, but right here you see that we make a lower low than here. So we have a low here, a high, a lower low, and then price expands up through here. And now we have a fair value gap here, as well as our breaker from over here. So we now have unicorn model. So you set your limit wherever you want. If you prefer the fair value gap, put it there. But if you want to play the breaker with the fair value gap, put it right at the breaker. And then where is your stop? Your stop can either be at the low of the fair value gap that created the candle that created the fair value gap here, here. But what I like to do with these is usually have my stop a tick below the breaker low here. So the low before the breaker and then the move down, that is where I have my stop. So this low right here, a tick below here, and you usually will be safe from there, because if it goes here, it's probably just going to come down through here, because then the fair value gap would also be invalid, and then you put your target on the obvious draw on liquidity. And that is how simple that was. And news drove us straight up to that obvious draw on liquidity at buy side. So let's go into another example. Here on Thursday, I was watching this sell side level the entire way down here. So that's what my eyes were on. And what I failed to realize with this unicorn model is we did not take these highs out on the NQ. But what I failed to realize is ES did. So we had an SMT. So technically NQ does not have to take out these equal highs. And right here we have our fair value gap. We have a low, a higher high, cutting through all these highs right here. Then we slam through this low right here, creating our breaker block. So here is our breaker paired with our fair value gap right there. And you see, unicorn setup. You see price ticks into here and then goes straight down to this sell side level. So short here, stop can be up here, or it can be above this candle right here. There. As you see, it came a tick in here and then target down here. This is why I like these setups. This is why I switched to the 5 and 15 minute, because look at this risk to reward. Let me show you guys an example on the 1 minute chart. So right here, I actually can't go back that far. This is the 22nd of November. You see right here, we have a high, a lower low, taking out these lows right here, which is sell side resting there, into a higher time frame PD array, the 4 hour. You see we expand up through here. We now have our fair value gap, our breaker block. Price comes down, I buy, and we go straight to that obvious buy side liquidity. That's how simple this is. This setup, if you have the draw on liquidity right, will work a lot. So right here on the hourly chart, I know this is a while back, but we do have our unicorn model. So right here, if we take a look at this piece of price action, we can see that this made a new high, right? So we have a high here, a low, a higher high, and then we slam through that low with this fair value gap. So we now have a breaker block here with a fair value gap here. So now on the hourly chart, we have our unicorn model. So if you're trading the hourly, swing trading, whatever you're doing, stop up here and target sell side. Boom, price comes up. We will disrespect this bullish PD array because the obvious draw is lower, and it was that weekly imbalance that was the draw on liquidity on the hourly chart. So let's head to the 4 hour and see if we can find an example real quick. So let's just do this before can I find one before I have to cut this? So we have a new high here, we have a breaker here, we have a fair value gap. This one isn't as pretty, but what did I just say? That weekly was the draw, and this low right here represents that weekly imbalance. Just trust me, I know. If you don't trust me, just go look at the chart. So here we have a low, we have a higher high taking out this high and this buy side level up here. Oh, whoa. Here, so we took out buy side. That weekly draw is that fair value gap. Slam through this low right here. So we have a breaker, fair value gap here. So now we have a unicorn model. So if you're trading the 4 hour chart, in this type of example, I would short the fair value gap just because I like shorting the fair value gap as well. So boom, boom, a 1 to 2.24. Price comes up, looks like it might come stop you out. Boom, we get that immediate draw down to that sell side level. So this is how simple they are. So for bearish breakers, it will be the last down close candle before the move up and then down through. So in this example, it would be this, obviously, as the breaker, the last down close candle before the move up and then back down to make that lower low. And if they are a bullish breaker, let's see, can I find one? Can I find one? Where? Whoa. Come on, come on. It is the last up close candle. Not really. Okay, so right here, if price would have came down here, it would have been this candle. We have a low, lower low. Actually, this would have been the breaker, so... Okay, you guys get the gist of it. If it is a bearish breaker, it is the last down close candle before the move up to make the lower low. And if it is a bullish breaker, it is the last, oh wait, here, it is the last up close candle before the lower low and then the expansion up. So it would be this candle here, bearish red candle before the move up to make the lower low down. So that is the unicorn model. This has a great hit rate. I would suggest if you were to trade any ICT model, it is find the draw on liquidity and then trade the unicorn model. Obviously, you can just add this to your arsenal. It is all up to you. You do what you want. And yeah, this is the unicorn model in a nutshell. So hope you guys enjoyed the video. If you're not in the free Discord, go join it. It is linked down below. And I'll see you guys in another video. Yeah, peace.